All right, guys, welcome back to the vlog. I am super behind in my reading, so I have a lot of time today, so I thought I would do some extra reading. Let's jump into chapter 9. This is a trading plan. Also, I feel a little guilty because I've been reading this dude's book, but like never once have I like encouraged a soul to go out and buy it themselves. So if you're watching, all three of you, what up? Yeah, go buy this guy's book. It's actually, I think this one's really good. Like, this is like an A to Z book. Obviously, I'm not getting paid for this. So I'm just encouraging you to buy the book because it would be good for you to have. I think it's a really good one. So start your library. Books are super important. According to Jim Rohn, human beings, we need two things: food, that would include the water part as well, and words. All right, trading plan, chapter 9. Let's jump into it. Trading is an incredibly difficult endeavor characterized by low barriers to entry and high competition from experienced and educated professionals. When first getting started, traders should focus on gaining the basic skills necessary to analyze and trade stocks for a living. The most important part of day trading, aside from preparation, is developing a plan that removes emotion from the equation and ensures predictable performance over time. In fact, plan the trade and trade the plan is one of the oldest and most widely known phrases in the industry. If you were around when I read the last book, literally there was a chapter in there, and I think it was called Plan Your Trade and Trade the Plan. So this is a super important concept. I've learned this through experience, but good information, like, you can never revisit it too many times. So, all right, as we saw earlier, common cognitive biases and logical fallacies can have a highly detrimental impact on let's start over. As we saw earlier, common cognitive biases and logical fallacies can have a highly detrimental impact on long-term performance. A detailed trading plan can help avoid these emotional landmines by ensuring that decisions are made ahead of time with a cool head rather than the heat of the moment as an afterthought. For instance, the overconfidence bias can lead to overtrading that leads to costly churn over time. A trading plan reduces overtrading by establishing a system to generate trading signals rather than relying on instinct. Trading plans also make it easier to predict trading performance over time. By backtesting and paper trading strategies, day traders can get a good idea of the returns that they can expect when trading in the market, instead of trying to guess what will happen. A day trader may realize ahead of time that a given strategy has a 20% maximum drawdown, and thus ensures that he has sufficient capital in place to weather the storm, rather than taking on excessive risks that could lead to sharp losses and perhaps even margin calls in times of trouble. Finally, the trading plan should include detailed record keeping in order to constantly evaluate performance. Many psychological phenomena make it easy to misevaluate past performance, which could lead to day traders losing money without even realizing it. For example, loss aversion could lead to a day trader underperforming the market by refusing to make the right trades over a period of time. By maintaining detailed statistics, these problems can be rapidly identified and avoided, while simultaneously gleaning other important insights. How to make a plan. There are many different elements involved in developing an effective trading plan. Depending on a day trader's performance and trading style, after setting initial goals, traders must build a strategy and consistently monitor their performance to determine if they're on track. Traders who experience lackluster performance might have to revisit their trading plan so that they can either adjust their expectations or their strategies for achieving their desired outcomes. In this section, we'll take a detailed look at all of these elements and walk you through the steps of creating an effective trading plan. All right, getting started. The first step in developing a trading plan is to obtain a base level of knowledge and experience in the market. Before embarking on a trading career, aspiring day traders should familiarize themselves with basic concepts such as placing orders, researching stocks, and the ins and outs of various asset classes that they plan on trading. It's also a good idea to begin paper trading in order to get a feel of the day-to-day process until they are comfortable enough using a platform, making quick decisions, and generating their target performance. After obtaining a base of industry knowledge, day traders should evaluate whether or not they are cut out for the job. Real talk. The financial risk, emotional stress, and a multitude of other factors involved make day trading a very intense job that's more trouble than it's worth for many people. Traders should be cognizant of these factors and carefully evaluate whether or not they want to pursue this career before going through the work of creating a plan and putting their capital at risk. Finally, day traders must set the right expectations from the start. Based on their financial commitments and paper trading performance, without the appropriate expectation and plan in place at an early stage, traders may be setting themselves up for failure. Building a strategy. All right, building a strategy. The most difficult part of developing a trading plan is finding strategy capable of generating consistent profit over time. While these strategies are constantly evolving, it's important for day traders to document their rules, performance, and changes thereof over time. These records will help ensure that there are records available to evaluate past methods and their success in different markets to avoid repeating mistakes in the future. The techniques used to develop these strategies differ depending on the type of trader. Systemic trading, day traders who develop specific rules for entering and exiting positions are known as systemic traders. Oftentimes, systemic traders will use some form of automation for finding and trading stocks. The use of specific rules also enables them to backtest the strategy against historical data to get an idea of how the strategy will perform over time. For example, foreign exchange or Forex traders may use MetaTrader 4 software to develop trading systems using the MQL programming language that can then be backtested and eventually enable them to trade automatically. Discretionary trading. Day traders who rely on their instincts to enter and exit trades based on real-time data are known as discretionary traders. Discretionary traders use tools like intraday charts, level 2 order books, and real-time newsfeed to identify opportunities and execute trades. Traders using this strategy should paper trade for an extensive period of time in order to ensure that they are capable of generating consistent performance. For example, a day trader may look at top movers for the day and buy into a stock with a large block bids in the order book, and then sell as the price nears key technical resistance levels and big block asks in the order book. There is no right or wrong when it comes to choosing between these two trading styles. In general, systemic day traders may benefit from more consistent performance due to their reliance on a well-defined set of rules. Discretionary traders may experience great variability in their portfolio size over time, but their ability to read the market might help them adapt more quickly to changing markets and capitalize on unique one-time opportunities. Managing money. Money management is the second most important part of a trading plan after the initial strategy development. If risks are not properly managed, day traders may take them on excessively, therefore jeopardizing their entire portfolio without even realizing it. Been there, for real. Documenting money management rules can provide a quick reference when immediate decisions need to be made in order to avoid any potential problems that may arise. The most important elements of money management to document include: number 1, minimum bankroll. Day traders must maintain minimum bankrolls in order to comply with rules and regulations relating to financial markets, stability, and margin. For pattern day traders, these minimum requirements amount to $25,000 at any given point in time, but all day traders should ensure that they have sufficient capital to trade in context of their maximum drawdowns and other trading system characteristics. Obviously, not obviously, but this pertains to the pattern day trading rule, having to have $25,000 in your account that you trade stocks in is specific to the stock market. So it's specific to the stock market. It's not specific to crypto. It's not necessarily it is not specific to trading currency pairs. What else? It is not it's stock. That's a stock market thing, so just be aware. All right, number 2, take profit, stop loss. Trading systems should have well-defined take profit and stop loss points in order to make the risk reward profile very clear. Very important. Without a stop loss level in place, day traders could suffer from cognitive biases that make it difficult for them to sell losing positions and avoid potentially significant downside. Take profit rules also ensure that traders hold on to winners long enough to enjoy the entire upside. Other rules: many day traders implement rules to ensure that they don't let emotion get the best of them. For instance, a maximum daily drawdown may be established in order to avoid the tendency to take on greater risk in an attempt to make back capital that was lost earlier in the day. Such losses can take an emotional toll on anyone, but trading systems can ensure that some of these rules are automatically followed. For example, I have a rule personally, which not to say that I've followed it 100% of the time, but I have a rule that if I lose 2 trades in a row, then I stop trading. If not for the whole day, then at least for like probably multiple hours, and then I can go back and I can reevaluate. But typically it's like for the whole day. And the reason why I set that rule for myself is because I keep a trading journal, and I came to realize, right, once I got out of my biases thinking that I was winning more than I actually was, I realized that I do revenge trade, meaning if I lose, I go back into the market way more like erratic, less focused, not really looking at like really my system of trading, just kind of like jumping into shit impulsively because I'm so upset that I lost money and now I want to get it back from the market, and then I end up losing more. And so that's a personal rule for me. And that rule, like for me, has changed the occurrence of me blowing entire accounts, right? Like in the beginning, I mean, I would have a trading account and literally blow the whole thing. Like it didn't matter if there was $4,000 in it, $9,000, whatever, I blow the whole fucking thing. So again, that's, the journal is really good. And if you notice that you revenge trade, like definitely put a rule in place to get a hold of that, because you will blow your account every single time. And I mean, if you're gonna do this, like, you know, you gotta be self-aware, and you need to know like what your weaknesses are and what your behaviors are when you're trading in the market. Because if you can't correct the things that you're doing wrong, then you're just gonna blow your accounts over and over and over. And I mean, the point is to make money, not to lose it or give it away. All right. The importance of money management cannot be overstated. Cannot. It is the single greatest barrier against emotional interference in trading. When a position is trading down, traders are tempted to make decisions based on their emotional state, whether that means prematurely exiting the trade or holding on to it far longer than they should, in hopes of a turnaround. Similar dynamics may occur when a position is trading higher and profits are on the table. Discretionary and systematic traders are often employ different types of money management strategies, but both of the types are aimed at achieving the same outcomes. Discretionary traders may manually place stop loss points and rely on their discretion when calculating take profit points, while systematic traders may develop an algorithm that automatically sets stop losses and take profits at the moment that the trade is placed. Keeping records. Record keeping is an important element of any trading system for 2 reasons: performance and taxes. Without regular performance reviews, recency bias makes it difficult to objectively know whether a trader is making a profit, whether a trader is making a profit or loss over time. Performance reviews can also alert day traders when they are beginning to lose an edge due to short-term or long-term changes in the market conditions, and help them to make necessary changes. The most important records to keep are gain or loss. The overall gain or loss is arguably the most important metric for day traders to consider, because it accounts for nearly every other factor in play. In the end, more gains than losses are necessary for long-term sustainability. Number 2, win-loss ratio. The ratio of wins to losses helps day traders determine their success in predicting directional movement. If the average win-loss is the same, then the win-loss ratio is the sole factor determining profitability. The sole factor determining profitability. Good fuck. Number 3, average win-loss. The average win-loss is necessary to determine how much of an edge one is exploiting in the market. If the average win is higher than the average loss, then the trader could get away with an adverse win-loss ratio and still profit. Maximum drawdown. Number 4, maximum drawdown. The maximum drawdown, or the maximum percentage decline experienced during a period of testing, is an important risk factor to consider and helps day traders manage their capital. If max drawdown is 20%, they should set aside enough capital to avoid a margin call should the worst case scenario occur. God forbid. Number 5, churn rate. The number of trades placed in a given period can help a day trader determine if they are over trading. In general, excessive trading can increase the cost of commissions and make it more difficult to generate a profit. However, I've seen people, I've had days as well where you go in the market and you're just like fucking killing it. And like, you're just killing it, and like, it really doesn't matter because you're making so much profit every single trade. But when that's not the case, like, you do have to pay attention to these things, because they can't add up. Because if you're losing and you're paying fees just to lose money to the market, like what are we doing? You know what I mean? All right, slippage. Slippage is important for day traders to monitor in order to better predict execution prices for future trades. In illiquid markets, slippage can add significant risk to establishing positions and can affect potential returns over time. Day traders can track many of these metrics automatically using their brokerage platform. While the data may also be compiled by backtesting an existing trading system against historical data. When just getting started, traders may also want to consider paper trading to see how these metrics compare to backtesting results before committing any real capital. Paper trading simply involves placing fake trades using live data through a brokerage demo account. Traders should watch for even small differences, which can be dangerous when extrapolated over long periods of time and significant numbers of transactions. Example, a day trader may begin developing a plan of action by identifying a viable trading system. By analyzing different combinations of technical indicators, the trader may find that the moving average crossover strategy combined with the MACD convergence divergence has generated profitable trading signals over the past 10 years. The trader may then decide to try out the strategy by paper trading in real-time financial markets, making a few changes and then fully documenting the results or the rules associated with the system. Next, the day trader will look at the trading system's characteristics to get an idea of how much capital is necessary. The trading system may have a maximum drawdown of 25%, which would require the trader to maintain 25% of capital in cash in order to avoid being wiped out during the worst case based on historical prices scenario. In addition, the trader may decide to stop using the system any day that experiences more than a 5% drawdown to avoid the tendency to make rash decisions following such losses. Facts. After implementing the trader's system with live money, the day trader should keep diligent performance records, both for evaluation and tax purposes. These records should consist of detailed transactional data, such as trade symbols, times, prices, as well as performance metrics, such as profit-loss ratios, average gains and losses, and risk metrics. Cool, quick recap. Day traders should have a rock-solid trading plan in place before committing any capital in order to avoid many common pitfalls, ranging from undercapitalization to the inability to determine if they're truly making a profit. Number 2, the first step in developing a trading plan is determining whether discretionary or systemic trading is the best option for an individual. Discretionary traders use their own judgment, while systemic traders rely on established trading systems. Number 3, day traders should have a sound money management plan in place to limit their risk and ensure the long-term viability of their business. These considerations include things ranging from position sizing to setting automatic stop-loss points. And lastly, keeping records is a vital activity to ensure long-term success and adaptability to changing market conditions. Day traders should always be looking for statistics like win-loss ratios, average win, and maximum drawdowns to evaluate their performance. All right, very cool. So that wraps up that chapter. I'm glad we did that today. Thanks for joining. Yeah, good shit. So we made good use of our time just now. That was good. I think I personally, I mean, I didn't read anything in this particular chapter that I haven't heard before. But again, I don't believe that you can revisit good information too much. Like, it's good. Like, I mean, I could probably read a lot of these chapters, I mean, damn near like once a week, and they would just be really great reminders of like fundamental things that we should all be practicing and like just doing regularly, like every single time we're trading. Yeah, all right, cool. So thanks for joining, and I will see you guys next time. Peace.